which is what? If we're bearish in London, you want to look for a single high or a relatively equal highs inside of the previous day's lower 1/3 or 1/4 part. Which is what? If we're bearish in London, you want to look for a single high or a relatively equal highs inside of the previous day's lower 1/3 or 1/4 part of the daily range of yesterday, whatever the yesterday is. If it's a Monday, it's Friday's daily range. Otherwise, it's whatever the previous trading day is. That's pretty simple rules, right, folks? So in between 2 o'clock and 4 o'clock, we would anticipate a rally above those relative equal highs on a 5 or 15-minute chart, whichever one's easier for you to see. Regardless, you'll see it. If you want to use a 15-minute chart as a bellwether, I use that as mine. But you can look at it on a 5-minute basis. And as it rallies above that, what's going to be resting above those relative equal highs or single high? Buy stops. And the characteristic for the London session is to run up and entice traders to chase it going long. When in fact, it's a function of running into buy-side liquidity for smart money to absorb those buy stops and be counterparty as they flood the market with buy orders. Shorts are entered by smart money there because it's a run on liquidity. It's engineered to provide a entry mechanism for smart money to go short. It takes a lot of confidence to take that type of trade because usually in London, the Judas swings are very violent and they're quick. And it feels like it's going to go up 100 pips. It's going to go up, 80 handles on the S&P. Look at this thing move, man. Wow, it's going up 12 handles. Look how fast it's moved. This thing's going to keep on going. If you feel that way, you're reacting to price. When we're looking for that to be a run real quick to get to those stops so that stops can't be pulled. And once that happens and the orders are not pulled by the traders that have those orders resting there, we anticipate price rejecting there and going lower. Now, if you can't take that type of trade or entry in the beginning, you won't. Let's just be fair. I say this all the time. Buying sell stops and selling short buy stops is one of the hardest things to do as a trader because at the time when it happens, it's fast, it's furious, and it's scary. And you have to know what you're looking for, which is why you have to anticipate and predict the future. You have to. Profitable trading is predicting the future, folks. I don't know why you want to argue with that, but that's what it is. So in London, you're looking for false breakouts and runs above relative equal highs when you're bearish or a single high that is inside of the previous day's range. Now, I know there's no chart here, but I want you to think about it conceptually. Let's look at it like this. If you have note-taking instruments in front of you, this should be an easy thing for you to do. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. Wait a minute. What do you mean open up ICT? Wait. No, look, you just said, and I understand that the market starts trading at 6 o'clock. What are you talking about opening at 2 o'clock? Yeah, now we have a new opening range. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning, on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble, because it can go up there and turn on a dime quickly, because London is a false breakout characteristic time period. When it runs up there, why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish. What did you just say? The best shorts will occur in the lower 50% of the previous day's range. Where do they form? Above old highs, inside of that range. Where you look for it, just like the algorithm will look for it, it's going to look into 15-minute high or highs, or 5-minute high or highs inside that range. So if you're in a 5 or 15-minute chart, it can't hide from you. It's right there. And you're going to anticipate the market running up there. And when it does, you paper trade it. You tape read it. You do not live trade it. You have to condition yourself to do this. And it takes weeks and months to do it. Not, a couple weeks I've been doing it. I know what I'm doing. No, you don't. No, you don't. You do not. It takes time to desensitize yourself to the fear that London can create, because it's very, very volatile. It can run up there and rip right lower, and really, if you know what you're doing, you can miss it or second guess it and totally do harm to yourself. So in London, you're looking for turtle soup scenarios, okay? And continuation on the basis of the higher time frame order flow. High a day, low a day is what's formed in the London session. Most of the time. Not all the time, most of the time. In New York session, this is going to be for Forex traders, the New York Open kills in, which is 7 o'clock to 10 o'clock, New York local time. If you are an index trader, you can use that same time window as well. You use that time window before the opening at 9:30, like between, say, 7 o'clock in the morning, New York local time, to 8:30. You can trade that time window when there is a really big high impact news driver for that day. For instance, like FOMC. I'm looking for setups in the New York session. The characteristic for New York is a continuation of what? Whatever London did. When does that not occur? If the range expansion that occurred in London and then continues into New York, and it trades to a higher time frame PD array, something that I would have been targeting anyway, which was the basis for the draw on the bias for the weekly chart and or daily chart. So in other words, if it gets to my higher time frame target, then what shifts in my analysis? Market reversal profile. Otherwise, I'm looking for New York session to continue in the direction of whatever that higher time frame draw is on the weekly and or daily chart. And I'm going to submit to that. And I'm going to look for the things that I teach you that the algorithm will show in price delivery, inefficiencies, runs on stops, the whole business. I'm looking for those factors to come in agreement with that. And if it doesn't materialize, or if it's wishy-washy, it could be done and explained both directions. That's low probability. It's not a trading environment I'm going to trade in. And then I watch, or I'll tell you, this is what we're looking at. We're watching it. So it gives you experience to see what it's like when it's not optimal, but still putting chart time in. You need to have that. And I have the other students that the New York session is a continuation of whatever London is. So if London was going down and it has not reached your higher time frame daily or weekly objective, we expect some measure of short-term retracement and then continuation in the New York session until the higher time frame weekly or daily objective that we would be reaching for as a draw on liquidity, the target. When that's hit in the New York session, then you are entering New York reversal profile, not market profile where they have the vertical volume bars going horizontally across the chart. That to me, I don't use that stuff. When I say profile, that's like a schematic or a roadmap or a visual representation of how the market should perform if you were looking at it from like a line chart basis, how it should look after the fact. But we're anticipating it to perform or behave a specific way. So New York sessions continuation of London, and then New York goes into market reversal profile where whatever happened in London in the early stages of New York now reverse and the market goes a different direction. Whether if it's going lower, now it will go higher, or if it's going higher, it will now go lower. If and when it hits the weekly or daily objective that we were aiming for that framed our bias or premise behind our trading week. Silver bullet inside of the AM session. That time window is very, very specific. It's inside of 60 minutes. Now, that doesn't mean the entire trade is encapsulated inside that 60 minutes, but most of the time you're going to find it is. But you can find the entry in between 10 o'clock and 11, and all you're looking for is a continuation of what London and or New York is outlining. So we have a target. We're looking for a draw on liquidity. It could be a new week opening gap that we're aiming for. It could be a fair value gap above the marketplace that we're aiming for if we're bullish. And that draw on liquidity is what we're looking for, a reach from that fair value gap that forms, whatever the fair value gap, the first one that forms between 10 o'clock and 11, that one, you're going to see that right there, that's going to be a catalyst for a minimum 5-handle run. The problem is you're not patient. The lunch hour. The New York lunch hour is technically 11 o'clock in the morning to 1 o'clock in the afternoon, New York local time. So it's a 2-hour window. And the reason why is back in the days where we had open outcry and electronic trading hadn't really taken off yet, sometimes if the morning session had a really nice move, guys would go grab a bite to eat because they felt like that we would have a very busy afternoon session. So they want to go early, beat the lunch rush to whatever it is, they would go and run and get their lunch. Sometimes they would eat at their desk, and others would be just hopped up on goofballs and simply not leaving the floor and just trade through the lunch hour. But lunch hour trading is a real thing, and the algorithm operates on that mechanism of reversing back to whatever the session in the morning stops, wherever they're at, whether they're bull stops or not bull side, buy stops or bear stops, sell stops or buy stops rather, buy side or sell side. And as an example, let's assume that we've watched the market go higher in London. And then we had a continuation in New York. And whatever the target is that we had for our weekly chart or our daily chart has yet to be reached. So we're still below it. Your expectation for the lunch hour between 11 o'clock and 1 is you want to go through and look for where a relative equal low or a 15-minute low is, because that's exactly where the algorithm is going to go. Don't take my word for what I just said. Don't just say, because ICT said it, I believe it. No, go back and look through your charts and you will see what I just said is algorithmically proven to you. It goes on every single week. It happens this way all the time. It does it all the time. It's flawless. It never fails. It's always in the charts. You can set your life around it as a model. This is one way that you can look outside of the AM session, the PM session, and go right in there. Once you understand how liquidity works and what you're looking for, that could be your model, your setup. And you're buying those sell stops as it runs underneath it. You're buying it. What makes it better? If there's a fair value gap or a volume imbalance just underneath that low, that right there is a unicorn. Why is it going to go down there? Because it's going to pick up more orders to allow smart money. It's not selling pressure. It's not a lack of buyers that lets the market drop. That's all the BS that's told to you in books and other authors and people out there that say, I've been in the industry. I used to be a trader at the desk. I'm a market maker. No. You're a trader with a religion. You were a dealer. They called a market maker. I'm talking about the mechanism that is the market that was coded and brought to us as a price engine that causes the fluctuations in price. And you chase it. Other traders, they chase it. They go in there, buy and sell after it. It will use that human psychology to know that there will be trades printed at the levels they want. When the algorithm's running, it's not going to go to some random level. It always goes to something that I've taught you as a PD array. In lunch hour, that 15-minute low, when it's been bullish and we haven't hit that weekly or daily objective, it's going to roll down there. It's going to go right below that low. And it's going to engage those sell stops. And the market's going to be flooded with willing sellers at a low price. Why, pray tell, would that be advantageous? Because smart money will be buying those sell stops to reaccumulate new longs, add to or start new positions, and wait for that higher time frame, weekly or daily chart objective to be met. And then you'll watch the PM session roll through and reach higher to that target or get closer to it ever so slightly. That's that liquidity matrix. Understanding where you are in it. You have to know where the market's going to go. That's the first rule of Fight Club here. You have to know, where is it going? You have to know that. If you don't know that, everything else afterwards, you're lost. If you don't know where you are going, where the market's being led to, it's an obvious level. It's in your chart. And that's what I'm sharing my experience with. I'm pointing to those things. I'm hoping that you're aligning yourself with, okay, I'm going to submit this studying price delivery in the basis of it's going there, and filter out all the things that would be opposing that as an idea in terms of trades, accepting the fact that there will be fluctuations that you didn't participate in. That's okay. That's discipline. That's you sticking with a rule-based idea, and you're keeping your focus on what is the highest probable direction. The market goes up and down, folks. Up and down, up and down. But where it's going to ultimately, once it gets there, then you can look back and say, wow, yeah, I can see how it was obvious there. But I'm teaching you how to see the obvious real time. So between 11 o'clock and 1 o'clock in New York local time, you're looking for a run on stops. What stops? The stops that have not been hit, and punishing those individuals that may have trailed their stop loss up below an old low or down below an old high. If you're bullish and it's been going up, a 15-minute low underneath that sell stops. It's going to run down there, take those, and then you're going to see it trade higher. Even if it fails and just goes to a higher high and never continues after that, that's still tradable. But some of you would think that that's a failure. It didn't keep going up to my target on a higher time frame chart, ICT, so that's a failure. Wrong. Did you get 5 handles out of it? And did you take 5 handles? That's how you start. That's how you build yourself up. That's how you grow. And eventually you do that enough and you start seeing setups that you know you've been here before. Yeah, I can get my 5, but let me take 5 off with half the position and leave a runner. And then you graduate to becoming a 10 handle trader. And you do the same thing for a little while. Let that build up. And then you start seeing, this looks like it's one of those setups that gives me a 25, 30 handle run. Let me take off half at 10 and then leave a runner on. And then you start growing into being a 25 or 30 handle trader. But you just can't make a decision cold turkey one day and say, you know what? I've done 12, maybe 15 paper trades, and I've done 2 of these 5 handle with my live account. So I think I'm ready for 50 handle runs. It doesn't work. It doesn't work, folks. That does not work. There's so much that you have to grow into and allow yourself to feel what it feels like to watch your profits go up and down while you're in those trades. Time. So silver bullets, you have a fair value gap set up that's very specific in that 60-minute chart or 60-minute time window. 1 hour at 10 o'clock to 11 o'clock. You have the lunch hour that runs on stops. Whoever's been making money, that's what it's going to do. It's going to run down there. Even if it reverses in the lunch hour, that's still a trade also. If you can anticipate that drop down, say the market's been going up, London session, New York session. Now you're entering at 11 o'clock to 1 o'clock an hour. You can sell short a 1 minute 2022 model and aim for that 15-minute low. What? Yes. Yes, Virginia. Yes, you can do that. That is a model in and of itself. What's wrong with it? Nothing. It might not fit your appetite. It might not feel like it's something for you. But honey, it pays. It pays the bills. It makes ends meet. And guess what? Car notes get paid with it. Rent gets paid with it. Mortgage payments get paid with it. Vacations get paid with it. Wardrobes get paid with it. Retirement gets paid with it. So what's your excuse? What's holding you back? Something's holding you back. And then you had the PM session, afternoon, between 2 o'clock and 3 o'clock. The same thing you would expect to happen in 10 o'clock to 11 o'clock, AM session, silver bullet. Well, look what we have here. Another 60-minute time window. We have to look for stops or inefficiency. Where's the market going? Where's it reaching for? You know you had that old high that you were aiming for all morning. It didn't get there. We have relative equal highs now across the afternoon. What's it going to reach for? The weekly and daily objective hasn't been met above the marketplace yet. So we're still bullish. Wait for a short-term shift in market structure, 1 minute and 5 minute. Wait for a fair value gap to form between 2 o'clock and 3 o'clock. And then when it drops down into it, when you're bullish, buy it and aim for that intraday high. If it can give you 5 handles, take it there. Leave a runner on and see if you can get to that higher time frame weekly or daily chart. That's how you trade your afternoon silver bullet. Simple. Real simple. There's a whole lot more things you can add to it to supercharge it, though. But that's the easiest, simplest little approach to that model being there every single day. Even in choppy days, it's there. Oh, it's there. Every day. Then you have the last hour trading. 3 o'clock to 4 o'clock. I've taught you several macros that exist in that hour. And now we're talking about the extreme of the daily range for indices. You're not trying to trade Forex back then at this time. At 1 o'clock in the afternoon, that's it. You're done for Forex. Don't touch it after that. I don't care how much you see it do this and do that. You don't trade it. In London close, between 10 o'clock and 12, I apologize. I skipped over that in all my favorite pitch about everything that's really outside the scope of this Twitter space that I had in mind. That 10 o'clock to 2 o'clock is the extreme range end of the daily range for your Forex trading pairs. It can extend to 1 o'clock, but generally between 10 and 12 New York local time. You can finish your whole business there and be done. But as an index trader, you're entering the lunch hour. Now you roll out of, say you're a Forex trader, and you want to trade a London session and New York session for Forex. And now you know that Forex goes a little bit colder the rest of the day in the US hours. Stop trading Forex, roll over into indices, trade the lunch hour. Where's the 15-minute stop? Where's the stops? Who's made money? Where are they leaving their stop? Because it's resting right in the marketplace, and the algorithm will gladly go down to it or go up to it, and there it is. There's a setup there. Then we get that last hour. That's making the high or low of the day for index futures. Not all the time, most of the time. Unless it reaches the daily or weekly objective intraday, and that will be the high or low of the day. If it has done that, then the afternoon last hour trading has to be traded from a scalper's mindset, looking for a 15-minute high or 15-minute low or 15-minute inefficiency above or below the marketplace. And that's your target, and be content with it. Does it offer you 5 handles? If it does, get it and be done. So I've walked you through a daily range, mentioned the characteristics. They're very generic. Do you think about price like that? If you haven't been thinking about price like that, now you should. Because in my mind, the inner musings of the ICT, when I'm watching the daily range form, I have all these thought processes in my mind, and I'm anticipating certain things based on the logic I've showed you and talked about here. I am not surprised. I am not taken back in a gasp when the market does something at any one of these times of the day. I'm expecting all this stuff. But anticipating it and entering the trade is 2 different things. In the beginning, you need to just sit still and watch. And you desensitize yourself. You remove all the doubt, all the fear, all the trepidation about you being able to do this. Oh, it's rigged, it's fixed, it's fake. He only shows you the winning trades. He this and that and that thing. You have all these excuses that you have to sort out. All that's put to bed when you start seeing it happen over and over and over again. When you start seeing it live, pan out to script. Whose script? Mine. Not Elliot's, not Sam Siden's, not Wyckoff. Mine. This market is absolutely predictable. But there's times when the market's going to be a little fickle. This is simply going to give you the setups that you like to see. New York session, optimal trade entries. London session, turtle soups that shift into 2022 model or optimal trade entry. Breakers really do well in London. Reversal market profiles in New York session. Once the targets on the weekly and or daily chart is met and reached, chances are we have an intermediate term high or low, and then a breaker can be forming there as well. You see how you can anticipate all this stuff? But you have to see these things. I talk about how on big down days or large range days, the big ranges beget small ranges, and small ranges beget large ranges. I learned that from Larry Williams, and I think it's a truism. It's going to never fall out of style. It's real. When there's a lot of excitement, when there's interest in a market, that's when everybody else feels comfortable going in. Low resistance liquidity run. The idea of looking for trades that are one-sided, where it's easy. You don't have to put a whole lot of thought into it, but waiting for those types of setups. Those are, in my opinion, what traders should be striving to trade and hunt, not looking for just any old pattern. You know, you're all learning my fair value gap. Not every little gap constitutes a low resistance liquidity run entry. When I'm teaching people to look at the marketplace, it's easy for someone to be critical and say, okay, look at this, you know, this fair value gap didn't work there. Oh, this didn't work there. This didn't work there. If you're going to look at what I'm teaching or investigate what it is I'm looking for, don't go in with the mindset saying, let's see how this fails. I want you to go in looking at how I teach you how to find it, because the critics, they avoid all that. They're not going to go through the process of doing it the right way as I outline it. And then you'll see that they exist. They're there in the move every single day, every single week. They repeat all the time. If you go in looking for moves that's just because you think it's a fair value gap, that's going to frustrate you, because it's not going to give you moves like yesterday. There may be fair value gaps there, okay, by what is defined as the pattern. But that pattern is not associated with the expected delivery of price for that given day. So what do I mean by that? As I outlined on Thursday, it was a large range day, and we're near the end of the range on that daily run that was lower from April high to May 12th. So we're, by definition, without the use of an indicator, we're oversold. We don't need an indicator to plot the fact that we're oversold. So the market's really, really, really suppressed, pulled down low. It's at a real deep discount. And we're at the end of the week, and we stopped short on S&P and the NASDAQ before running out May 12th's low. But the Dow was able to go through May 12th's low. So all of those ingredients come together and create this product called consolidation. And those days, if you don't know what you're looking for, when to anticipate them, how to read them, you can go in and trick yourself into thinking there's a pattern there. There's a pattern in anything. You can be fooled by randomness. But when you apply logic and the narrative that would be associated with a low resistance liquidity run, that means it's a high probability one-sided price move that is justifiable only on the side that you're trying to trade. In the beginning, when you're learning, it's not going to feel clear to you as to what that means. And that's why I tell everyone, you have to take your time. You're going to get these moments of astonishment where it's like, I finally got that. It's an epiphany where you discover what you didn't realize was important to you. Now suddenly things become a lot more clear. And that is the byproduct of going through back testing, looking through old data, and studying it. You immediately go to the toxic excuse as to why it's not working for you, when the whole concept and the point was, go into the marketplace, study, what is it doing? How is this going to benefit me? Or more importantly, how could I be harmed by this? Because if these environments repeat, they do. If you know what they look like going in, or once you get involved and you can identify what it is in terms of a market profile day where it's likely to consolidate and chop you up, how do you engage with that? How do you trade it? Well, I gave you insights yesterday on how to do that. Stop trading off until all throughout the afternoon, wait till that last hour trading. and look for a pattern that makes sense. That run on that buy stops and pull back to the middle of the range. Talking about making money and not really emphasizing the underlying risk associated to doing this is irresponsible. And I want you to understand where you're going to lose. I'm telling you, you're going to lose, but I want you to know that it's assuring to know where these pitfalls are likely to materialize. Some people are not going to want to find value in that, like yesterday's entire drawn out discussion throughout the day. That is a day that will absolutely lead you down. When you have a one-sided market gearing where a low resistance liquidity run for like a run to old high or old low is what I'm kind of really trying to teach my store. It'll have a very clear pattern and expectation at the opening price, or not the opening price, at the opening at 9:30. You'll get this flurry of price action. Like if we were bearish, the ideal scenario in my mind would have been run up, take out the 39.50 level, and then break down, then come back in for a fair value gap, and then run for 39.15 and a quarter. Yeah. We want to see one-sidedness when we're looking at the marketplace. And if you don't have clear one-sidedness, and then if you're expecting bearish prices, the obvious would be the market rallies above the opening price, runs to either an old high or rebounds to a fair value gap, then breaks down and goes to a low resistance liquidity run for sell side liquidity below old low. That is, to me, what all of you should be hunting for. That's your unicorn. Okay. They exist. They're in the marketplace, but they don't form every single trading session every single day. You'll have a handful of those over the course of a week. But apart from that, you can do tiny little scalps. They may not have the same level of probability behind them, but if you're getting 1 for 1 and you know what you're doing, you're not over leveraging yourself, you can grow an account with 1 to 1. You don't need 5 to 1, 50 to 1, 200 to 1 like these guys on Instagram and Telegram rooms. Yeah, I'm doing. If you ever done the math on these guys, they're olds, okay, but they're claiming they got 500 to 1 trades. Why aren't they billionaires? Like seriously, why? If you can do that, why are you trading with 1 micro lot with your MT4 screenshots? Like it's been 6 months. You should be at least above a standard lot now. The things that people believe and swallow just because they see 1 screenshot of something is ridiculous. And all I try to do is be a voice of reason. Okay. I could do a lot of those things for real that they're pretending to afford, but it does nothing to make you a better trader. Thinking about things responsibly, respecting the level of risk, and doing things that are boring. Trading is boring. You want it to be boring. Your job sucks, right? Everybody hates their job. You're there. You have to put in the time. It's boring. You'd rather be doing something else. Trading is like that too. People say, oh, I love trading. No, you don't. You don't love trading. You love trading when it's profitable. Okay, let's be real. You don't like trading. You don't love trading. You love winning. Okay, but everybody wants to love trading. I eat, sleep, breathe trading. Yeah, I do those things and I hate it. Like I hate it. I love backtesting. I love studying price action. I love that. I hate trading. Why do I hate trading? Because every single one of these candles that form, I'm expecting it to do what I want it to do. Think about that now. I'm being 100% honest with you. I want every single one of these candles to do exactly what I want them to do. And that is an internal struggle for me because I have mentioned many times I'm obsessively compulsive. So I want things my way. I am an absolute control freak on every aspect of my, and when I look at these candlesticks, it's an internal arm wrestling match when they don't bend to my will. So in my approach to learning how to beat these markets, I had to align myself with how they book. And I was blessed and fortunate to end up in the situations that I was in, that I was able to learn what these things do. There are times when I don't know what they're doing. And it was a hard process for me to learn when that is. So one of the things that come up a lot is, why do I stay away from trading on Thursday and Friday, or even the afternoon session on Wednesdays on the first week of each month? And it's only to do with the inconsistencies with the market symmetry and the things that I call a signature and price action. They will come in and out. They'll be hit and miss type setups. I've learned over the years that it's just better for me not to take these trading days with live money, because the probabilities are much lower than they are when they're not on those particular days. Not the same as like a FOMC. Like FOMC day, I can sometimes do go in after the FOMC announcement because it's created volatility. But ahead of the FOMC, I won't be in front of that, because it's basically a gamble. You don't know what they're going to do. For non-farm payroll, the elements about that week, and what you've learned hopefully this week, was that in the beginning of the week, this is what I teach my students, that Monday, Tuesday is kind of like your honeypot. You want to go into the market looking for your setups there. And if you don't find it, try to force it. You don't insist upon taking a trade. But if it presents it, you try to take it then. And then at the New York session on Wednesday, that's like your cutoff time. It's closing time. If you want to go in after that, just know that you're gambling. You're not doing what I've taught you and high-fiving me and putting up your trades and tweeting to me saying, thanks ICT, me for that, because I told you not to do it. Okay, so if you made money, that's on you. And if you lost money, guess what? That's on you too. But I see a lot of folks that will post, hey, what do you think about this? What do you think about that? And apparently they're not listening, because here's what I think. On Thursday and Friday, you shouldn't have been trading. That's what I think. And what do you do in those days? Well, basically, you're students, okay? You're learning. And even if you've been trading for a while, if you're listening to me, you are a student, okay? You're learning what it is that I do. Whether you're going to use it or not, you're a student. So you don't want to be doing the things that I'm telling you not to do, because if you do that, you're wasting your time under my tutelage. You're not going to benefit from it. Apparently, some people like to come and they'll say, hey, look, ICT says don't do this, but I made money over here. Okay, that's fine. When it rains on everybody. Okay, that doesn't mean that you did something right that day. It just means that when I first started making money years ago, back in the 90s, I had 9 months of sheer luck, folks. And it's not painful for me to say now. It was painful at the time to admit to myself that I wasn't as good as I thought it was. Like, I thought that books that I purchased and VCR tapes and CDs and everything else, well, not CDs, but DVDs were coming up then. And I thought that logic was building me into a juggernaut. And, well, the only thing that was a juggernaut is how fast I blew the accounts. Because once the market started going into a trader's environment where everything stopped going parabolically one direction up, I discovered that I didn't know how to trade. And that was very painful to watch me blow not 1, not 2, not 3, not 4, but 5 accounts. 5 accounts in 1 year in the 90s, trying to force what I thought the books were working for me initially with. And it's a terrible experience. But when I tell you these things, what to avoid, what not to be doing, and then I see folks going out and doing the very thing I tell you not to do, and the worst thing that can happen is for you to find short-term success doing the things I tell you not to do. That's exactly the equivalent of what I was doing for 9 months in 1993. And it was not skill. That was luck. And you were lucky if you made money on Thursday. You were lucky on Friday if you made money. Now that the dust is settled, it's Saturday. If you look at the 5-minute price action on the E-mini S&P, now I don't have a chart in front of me, but I know what it looked like. It was very boring, very sloppy. Yes, there was a setup. Yes, there was a few tiny little scalps. But if you were in there looking for a particular run, that would be framed with a larger degree of probability, not something just on a 1-minute basis. But there's other times when you're going to be correct in your analysis. You're going to be absolutely right with what it's going to do and where it goes and how fast it'll move, all those things. But it won't let you get on board. And those missed opportunities, those trades that didn't materialize because there was no trade in any of the things that I teach at 8:30 on Friday. It just simply ran away. Now you're left with a choice. You're left with the choice of being frustrated and beating yourself up and spending the entire weekend and going into this new week angry that you missed it, angry that you have blown that one opportunity, that 1 week of trading that moved so much. Huge range on Thursday. And you somehow are equating that to the only moves that you're ever going to see in these markets. And that I want to address because that is the incorrect perception. And I didn't have anyone to correct me when I thought that same thing in the 90s, when I saw something for me and I expected it to be a big blow up move. And I had every intentions of being a part of it. I'm going to talk a little bit about how I first started trading and how I was trading, driving around in a truck doing bending around because I got a lot of questions about that. So I'll talk a little bit about that today. The frustration of not being a participant on the move, that's normal. I want to remind you that you're going to miss a whole lot more moves if you plan on doing this the rest of your life. If you're trying to make this a career and not a field trip to the casino, because that's unfortunately what ends up happening with new traders, new students, new speculators. They come in and they're already afraid. They're afraid to lose money. They're afraid to get it wrong. They're afraid to do something that doesn't feel comfortable when that's what trading is. So you have to warm up to the idea that you are embracing uncertainty. That's what you're doing. You are embracing uncertainty and you're becoming a professional loser. You're managing every losing trade that begins because you're underneath all the costs, any commissions, any spread. You are starting every single trade in a losing position. You have to trade your way out of it. But it's easy when you have nobody to tell you in the beginning that lose is part of it, and don't beat yourself up about it. You should take away from last week that the market did in fact move as we were expecting. The market did not present an opportunity for you to actually engage it. So did you really miss a trade? No, I didn't miss a trade. I missed a move. I missed the phenomenal move. But I've missed a lot of moves over the last 30 years. It doesn't bother me. In the beginning, it did. It hurt. It felt like I was never going to get the next one. Patient, just like you probably are feeling right now.